This is my crystal ball, and I can predict everything the stock market will do in the future thanks to it. Look, never believe someone who says that to you. Most likely, they're just attempting to sell you one of those $997 courses. There are some things I do to improve my odds, and that's what I'd like to share with you today, even if there isn't a magic wand that can tell you when to buy a company before it soars in value and makes you a millionaire overnight. As I've become older and a little grayer, I've discovered that understanding the factors that could affect a stock's price has helped me make and save a lot of money. If you're unfamiliar with the stock market, a stock is a relatively small portion of a firm that when you purchase it makes you a partial owner. The objective is to invest in a business that you think will increase in value so you can quadruple your money without putting in extra effort. But let's face it, stock market trading can be very complex, and the majority of individuals just choose firms at random. That's not how I do it. So by the time this video is over, you'll be aware of my genuine stock picking methods. And do not fret, you may sit back and unwind since I won't be attempting to sell you anything. Consequently, there are two main approaches to making stock market predictions. Technical and fundamental analysis are what these are known as. This can be thought of as a scale. For example, short-term day traders typically only pay attention to technical factors. Among them is examining graphs and trends. They think that by analyzing the highs and lows on the graphs, they can forecast how much the stock will fluctuate in price. They are the nerds. I'm just kidding though. I just don't do things that way. My entire approach to investing is focused on simplicity. Although many people discuss margin and options, I actually don't bother about that. Being a long-term investor, I place a lot more emphasis on a company's fundamentals. This covers the company's finances, management style, and brand awareness, because in my opinion, these factors can best predict a stock's long-term performance. But since it's a scale, as I just said, I occasionally go over a chart to choose when to buy. Instead of merely jumping in and out and attempting to earn money every day, this strategy has helped me identify some very great investments over the years. Amazingly, most seasoned traders are still unable to outperform low-cost index funds over the long haul. Although it may seem difficult, this is really fairly easy. So the water in this bucket represents me investing all of my money in that company, and each stock in it is represented by the bucket. Each cup represents a distinct company, and the water I'm adding reflects the money I'm dividing among them in a single simple investment. This represents an index fund. Guess what happens if this business fails for whatever reason? My money is completely wasted. Even if this is the same firm and it still fails, the good news is that even though I might have lost money on one small investment, I have a lot more stocks and have done well in other of them. So I've actually gained money. The S&P 500, which represents the top 500 public corporations in the USA, is tracked by my favorite index funds. So even though I put most of my money in index funds, I also enjoy picking individual stocks and keeping track of my portfolio's growth. Well, if you're anything like me, starting with the numbers makes sense. This is what we mean by quantitative analysis. Every time I consider investing in a business, I make sure to first review all of these numbers. It's quite rare for me to conduct any additional investigation on a firm if the financials don't seem promising. It's similar to how you might meet someone on a first date and think they're incredibly wonderful. But if you get to know them better, you might start to see that they have defects, like eating with their mouth open or picking their nose. If only they provided you with a thorough, unbiased description of who they really are, so you could decide whether or not you wanted to date them. I don't have a solution for this issue, but fortunately, businesses already do that. It's fantastic. On Yahoo Finance, the service I use, you can get this information for nothing. 3 primary factors are what I focus on. Let's dissect the balance sheet first. Trust me, this is where you get some of the really tasty material, despite the fact that it doesn't sound really engaging. The name of the sheet sums up its entire objective: to balance assets and liabilities. Consider it somewhat like this. Your assets might be a watch or a rental property, but let's say you also have a lot of credit card debt. This is one of your liabilities. So let's decipher some of the jargon so you can dazzle your pals and easily comprehend this confusing-looking form. Three sorts of assets are distinguished. Things that could be converted into cash within a year are referred to as current assets. Their headquarters is an example of a longer-term asset that they typically don't sell quickly. The term intangible assets refers to assets that a company may have that are not tangible, such as the long-standing reputation of a well-known company. I enjoy considering Coca-Cola. The liabilities are the debt that must be repaid within a year. Thus, I'm most interested in the current liabilities when it comes to these. In light of this, you may quickly determine if a corporation is high risk or not by dividing its total current assets by its total current liabilities. The numbers here should, as a general rule, be above 1. But how does this function in actual use? Take Apple's balance sheet as an illustration. Rounding up, the ratio of Apple's total current assets to their total current liability is 1.4. This is fantastic since it shows that Apple can pay off all of its short-term debt almost 1.5 times over. The income statement is the second document that needs to be carefully examined. This is the origin of the expression top line and bottom line, if you've ever heard of it. The total revenue, or the amount the firm takes in, appears at the top of the statement. The net income, or the amount the business keeps after all expenditures have been paid, appears at the bottom. These costs, the cost of operation and the cost of income, are incurred by every business. So let's look at a straightforward startup like a smoothie maker. Fruit is their source of revenue. Without purchasing that, they cannot manufacture their smoothies. They therefore have no choice but to pay that price. It's a straightforward aspect of doing business, but the next thing they can control is their operating costs, including who they hire and what kind of salary they give them. You obtain the operating income by subtracting these costs from the total amount they receive from clients. So operating income divided by total revenue multiplied by 100 is how I determine whether a business is healthy. I aim for a percentage of over 15%. Let me know in the comments if you have any other questions about investing. Let's return to the video. The statement of cash flow is the final of the major three. When it comes down to it, this one is rather straightforward, so I won't spend too much time on it. My biggest concern is whether the business I'm considering investing in has increasing free cash flow year over year, which is money that can be used to reinvest all investor repayments. The fact that the corporation occasionally has negative cash flow, while nevertheless paying dividends to its stockholders, raises a serious red flag. It's simply unsustainable, and ultimately the company will run out of money. After carefully examining all of these figures, it's time to move on to the interesting material, which involves examining a company's characteristics. Qualitative analysis is the term for this. Brand recognition is one of the characteristics I search for. Most people think of the firm rather than the fruit when I mention the name Apple. Even though I keep mentioning it, it's a fantastic illustration of incredible brand recognition that is here to stay. There is a lot of consumer trust that comes with having a household brand name. People are therefore far more willing to check out new products when they are introduced, especially if they are innovative or unusual, like the iPad. This aids organizations like Apple in defining our future and develop entirely new markets and sources of income. Coca-Cola is an additional excellent illustration of brand recognition. After OK, it is the second most widely used word worldwide. The news is something that significantly influences price changes. I constantly monitor everything, especially rumors on social media. You may be familiar with the GameStop incident in which a tiny group of retail investors outwitted the top hedge funds by spotting a vulnerability in its strategy. They were able to take advantage of this and generate a large income. It's David and Goliath on Wall Street this evening. Over the course of 6 months, sales at struggling video game retailer GameStop increased by roughly 8,000%. But as soon as word spread and additional people jumped on board, the major money had already been made. I learned a useful lesson during the dot-com boom in the 1990s. Buy the rumor, sell the news. This is an excellent illustration of the proverb. People were astounded when I first began investing that I was putting money into businesses whose major asset was a .com domain name. But after 6 months, it seemed like everyone, including my hairdresser, was telling me they were purchasing stock in .com businesses. Just a few weeks before the bubble burst, I made the decision to start selling in order to buy more real estate, and I was able to keep the majority of my earnings. Others were not as fortunate. The majority of the initial businesses never recovered, and although everyone believed that online businesses were the wave of the future, and they were ultimately correct, I witnessed several of my friends gain millions, only to lose 90% of their investment when everything fell. Only a small number of businesses, including Amazon, were able to survive the storm. This demonstrated to me how the hype created by the media and other people's discussion of it just served to drive up prices to unsustainable levels. So whenever I sense that a stock's price is being driven by hype, I am aware that it is probably not a wise long-term investment. Although it is true that many businesses eventually recovered after the dot-com bubble, the leadership of the company is the next crucial aspect, which is now even more relevant given social media, and what the leaders say has a significant impact on the stock price. Elon Musk is a shining example of this, who is unquestionably the visionary behind all of his businesses, Tesla being one of them, of course. Actually, it was Top Gear in 2008 that introduced me to Tesla. The fact that the automobile ran out of batteries after only 50 miles, less than a fourth of the claimed range, made the review less than favorable. Elon wasn't too pleased with this, and he eventually sued the show as a result. But the section definitely caught my attention, and I could see they were onto something. Every industry has undergone a significant change since I started investing. I recall watching this man approach with a sack of coal on his back as he delivered it to my grandma, so she could heat her home while I was visiting my grandmother's place. Mr. Coalman is no longer necessary because the majority of people in today's society consume gas. With the development of renewable electricity, this industry will also soon change. But they are the 3 biggest changes I'll see in my lifetime. My investments would have been a thing of the past, much like the coal business, if I hadn't been willing to adapt and recognize these developments. So before buying a stock, I constantly consider whether a potential sector move will be favorable or unfavorable. However, how can I figure out when to buy? You don't, but I do, and I utilize a technique called dollar cost averaging to get around this. Consider making an investment once every month for 3 months. The stock might cost you $200 in month 1, $150 in month 2, and $130 in month 3. Of course, if you had known the price would drop to $130, you wouldn't have bought it then, but no one can predict just how low it will go. However, by doing this, you actually lower your average buying price to $160 as opposed to investing all of your money in month 1 when your stock was at $200. Another name for this is purchasing the dip. The goal is to buy more rather than panic and sell like most people would do, since it's like having a garage sale. And if you've done your research and like the company, then the stock is at a great price. The following video will therefore be left up there, but don't click on it just yet. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.